India still remains one of the fastest growing major economies despite a slight downgrade in its near term growth outlook. In its latest World Economic Outlook update, the International Monetary Fund has projected India's economy to grow at 6.4% in FY27, marginally lower than the 6.5% forecast it had made in April. However, the IMF has turned more optimistic about the following year, raising India's FY28 growth projection to 6.7% from 6.5% earlier.
For India, we have the forecast for this year revised down very slightly by 0.1 percentage point to 6.4, and growth for next year for 2027 revised upward by 0.2 percentage point. And the factors that are underpinning the forecast revisions are basically twofold. On the upside, we have the better than expected outturn in the most recent data, but we also have high frequency indicators through April showing quite a bit of resilience in overall economic activity. But these positive effects are then more than offset for 2026 by the higher energy prices we have in our baseline in the July update, as well as the greater pass-through of those higher oil prices to prices at the pump in India. And moving into 2027, we are expecting a strengthening with the energy shock dissipating and medium-term growth being estimated at around 6.5%, and output growth closing, we expect some pickup there.
Globally, the IMF expects economic growth to slow to 3% in 2026, before recovering to 3.4% in 2027. The fund says the global outlook is being shaped by two competing forces: the lingering impact of the Middle East conflict on energy markets and a technology-led investment boom driven by artificial intelligence.
The global outlook is being shaped by two powerful forces pulling in opposite directions: the lingering effects of the energy shock from the war in the Middle East and a technology-driven investment boom. Developments overnight illustrate the uncertainty and risks that surround the outlook. So far, the net effect of these forces varies significantly across countries, depending on their exposure to the war and their position in the technology value chain. We are projecting global growth of 3% in 2026 and 3.4% in 2027, broadly unchanged from April on a cumulative basis. In effect, we expect a V-shaped recovery, weaker growth this year relative to our pre-war forecast, followed by a rebound next year. On inflation, the picture is somewhat less encouraging. Global headline inflation has been revised up to 4.7% this year, while our core inflation forecast is broadly unchanged. Put simply, the disinflation trend that has been in place since early 2024 has stalled. Nevertheless, the world economy has weathered the shock from the war better than feared so far, with limited evidence of second-round effects. A larger spike in oil prices was avoided thanks to inventory drawdowns, expanded production outside the Gulf, and actions to help soften oil demand. And a steady rise in the renewable energy share, combined with lower energy intensity than just a few years ago, has also made many economies more resilient. And while financial conditions tightened sharply in early April, they have since eased and remain supportive by historical standards. Now, our forecast assumes that the Strait of Hormuz begins reopening in mid-July, with conditions normalizing to the pre-war state by March of 2027. Commodity price assumptions are based on market pricing as of June 10th, which implied an average oil price of $89 a barrel for 2026. Though I'll note that the futures curve since shifted down a bit, although, of course, developments go in the other direction this morning. We also assume policy and geopolitical uncertainty remain elevated throughout 2027, and that the AI-driven technology cycle moderates from here, with no exogenous boost to productivity.
A renewed escalation in geopolitical tension could once again push up commodity prices, tighten financial conditions, and weigh on global growth. At the same time, faster adoption of artificial intelligence, and a quicker normalization of energy market could provide an upside to the global outlook.
Now, turning to the risks to this outlook, they remain tilted to the downside and there's a lot of uncertainty. A renewed escalation in the conflict could reignite commodity price volatility, tighten financial conditions, strain policy buffers, and worsen food insecurity in low-income countries. A market correction driven by a reassessment of AI profitability is another key downside risk. On the upside, faster AI adoption could lift growth, and a swifter than expected normalization of trade through the Strait of Hormuz would also be a positive surprise.